Now we're going to go ahead and move forward and talk about accounting for the extinguishment of debt. When the normal course of bonds run, so it has gone through its full term, uh, the documentation of the extinguishment of debt is relatively clear cut because the cash out and the book value or the carrying amount of the bonds are going to be equal. Cash leaves, debt is extinguished. You debit the liability account to reduce it by the amount of cash that is leaving and paid to the bondholders for that maturity or face value. Everything is balanced out. It's super easy. However, reality and the timing of debt retirement are not always so very clean cut. With call provisions and redemptions, companies can call for the redemption of a bond prior to the maturity. Now, remember that sometimes there's protections on that call, which gives it a minimum threshold time, and that there's typically a call premium that is also going to be attached. So, to illustrate this, we're going to actually look at a situation. So, the amount that is paid to extinguish the debt, this is the entire proceeds out. This is the call premium. This is the original obligation. This is the reacquisition price. That is how this amount right here is calculated. So this call premium um, is 0.01. So we are going to extinguish this debt at 101%. Um, Often, what this will result in is a loss on the redemption, and we will calculate that by starting with the reacquisition price. This is how much we're going to have to pay out. At this exact point in time, the books are going to reflect the maturity value less the unamortized discount. So we see that the unamortized discount at that point in time is 24,000. And when you are closing out debt and you're removing it from the books at extinguishment, any premiums or discounts applicable to the bond issue must also be closed out or removed. They're no longer valid as a part of the representation of the financial statements of the organization. So that's why the unamortized portion needs to be taken into account. However, before you begin this process, you need to engage in an amortization calculation uh, through the exact point of the reacquisition. So you will fractionate it and you will bring the carrying amount of the value of the books up to that exact point in time. Because typically you're going to amortize every 6 months. If this happens in between, uh, interest uh, entries and interest payments, then you're going to need to take care of that as well. When you have more in acquisition price, so 808,000, and then when we look at the net carrying value of the bonds at that exact point in time, it was 800,000 less 24,000. So that's 776. So when you are paying out more than what is currently on your books, you're going to have a loss on the redemption. So this is just the basic calculation. We take what's going out less what is on our books to determine loss or gain. So General Bell has to record the reacquisition and the cancellation and extinguishment of the bonds on the books. So the first thing we know is that we will not have, we will be retiring 800,000 worth of bonds. So we will debit that. Uh, we calculated our loss at 32,000. We have discounts on bonds payable that needs to be closed out of 24,000, and we're paying cash out of 808,000. If the situation occurs that an organization calls a bond issue and they replace it with a new issue at lower interest rates, we call this refunding. Regardless of the purpose of the extinguishment, gains or losses need to be recognized in the period of redemption. So I will leave these slides up here for a second. You can, of course, hit pause to give you enough time to read through this. But this is talking about investors in the equity and bond market operating in their own separate worlds. They're both volatile markets. However, movements in the bond market can have movements resulting in the share prices. So this talks about at extremes and how investors can see what might be going on. This is the second page of this specific sharing. Be sure to have read these and just kind of have a little bit of an understanding, real world, how this is how this is having an impact, how this inverse relationship exists. We're going to go ahead and move forward and talk about the accounting for long-term notes payables. You'll recall that how we determine whether it is current or long term is based off the maturity obligation, and that those due or that portion due within a year or the operating cycle is deemed current. The amount due or those that are completely due outside of that period of time are long term. We have a lot of similarities between notes and bonds. So a note is valued at the present value of its future interest and principal cash flows. And then any discount or premium gets amortized over the life of the note. Both bonds and notes payables have fixed contractual maturity dates that are absolute. And there is a stated or an implicit interest rate that is attached to them. They are defined obligations. So, notes that are issued at face value, these are relatively simple. So, the stated rate and the effective rate at that point in time were both 10%. So, we would recognize a proceed of, in this case, they received cash. So, they had received cash at 10,000. They have a notes payable of 10,000. This is a 3-year note, and it doesn't reference that there are any installment payments. So, the entire obligation is long term at this point. And then they would recognize interest that's incurred each year, and we're going to assume that they pay their interest each year. So there is an interest expense of 1,000, which is 10,000 times the APR of 10%, because keep in mind, interest is quoted to us in an annual percentage rate, and cash leaving of 1,000. Now, sometimes notes are not issued at face value. For example, we may have zero interest bearing notes. This is when the company records the difference between the face amount and the present value as a discount, and then they amortize that amount to expense over the life of the loan. So the company receives a certain amount. Uh, for example, maybe they receive just in excess of 7,000, but they will pay at maturity 10. The amount that is in the difference there is representing the interest expense, and it needs to be amortized to the periods over the life of the loan. So to look at that, we're going to use Turtle Cove Company, who issued a 3-year, 10,000 zero interest bearing note to Jeremiah. So the implicit rate, because this is a zero interest bearing note, it's not stated, is calculated based off the cash proceeds and the amount at maturity. So we had 10,000 at maturity. We had 7,721.80 in cash proceeds. Uh, so these, we know what the present value of the 10,000 is. So then what we will do is we will determine what that implied interest rate is. When we take that back to a time period of 3, then we recognize that this is a 9%. So with the issuance of the 10,000 zero interest bearing note with an implicit rate, which is the result of the total cash to be paid in the future less the future cash flows, the present value of the future cash flows, my apologies. That gave us proceeds of 7,721. So when we receive the cash, we receive 7,721. We recognize the difference of 2,278.20 into the discounted notes payable and represent our entire obligation that is due in 3 years. Therefore, it's a long-term notes payable of $10,000. Now, your discount on notes payable is going to be a contra account attached to notes payable, representing notes payable at any given point in time at its specific carrying value for that point in time. This means that we have to create a schedule of note discount amortization. Remember, the effective interest rate method is the preferred method, and you can only use straight line if the difference between the two is not material. So we do this the exact same way. Now you see here, we're not looking at cash paid. We're just calculating for their interest expense. So we have the carrying amount of the note. This is how much we received. We multiply that by 9% because that is our implied interest rate. So we have $694.96 of interest expense that we need to recognize at the end of year 1. We move that out of the discount, and therefore we have an increased carrying note value. And then we continue this through all the periods. Now you'll notice here, and this is very common, that there's going to be just a little bit of a rounding adjustment. Um, it happens because we carry out for things such as present values so far. Uh, we try to get as accurate as we can when we're entering into these schedules. But sometimes we just have an extra little few pennies that have to be taken care of in that end period. The net effect is that at the end of the term, the maturity value and the carrying note amount of the note will be the same. So the interest expense at the end of year 1 is going to be $694.96. And then we're going to recognize that against discount on notes payable. So in effect, what happens is that we actually prepay our interest by not receiving the proceeds in their entirety of what the maturity value of the obligation is. It's not that we're not going to pay interest. It's just that we don't pay it over time because we prepaid it all up front. So with an interest-bearing note, again, the effective interest rate method does come into account. We have Marie Co., which issued for cash $10,000 3-year note bearing interest at 10%. Market rate for the interest is 12%, and our stated rate or coupon rate, our nominal rate is 10. So the present value of the note is calculated to be $9,520. We have an additional discount on notes payable for that $480 to represent the full $10,000 to be paid out in 3 years. We create a schedule of note discount amortization, very similar to the schedule of bond discount amortization, underneath the effective interest rate method. Now, in this case, we have the 10%, but it's discounting at 12. We have regular payments. So we start with our carrying amount of our note, $9,520. This is the amount of cash proceeds that were received. It was discounted because our note is only going to pay 10%, but the investor requires 12. So they paid us less than the full 10,000 so that they can make their 12%. We have our regular payments of $1,000. This is based off the 10,000 times 10%. This is stated in our contract, um, and this is what we are honoring. Our interest expense, though, as to the expectations of the investors at 12% is 1,142. So we will adjust 142 from the discount on notes payable, which will in effect increase the carrying amount of the note, and we will recognize this for our first year's interest. So our interest expense being 1,142, this is the calculated expectations of the investor based off the effective interest rate at the point of issue. We reduce our notes payable by the difference between the interest expense and what was being paid out, which is 142. And we recognize the $1,000 cash payment. As we said, the calculations and the accounting between notes payable, long-term notes payable, and bonds payable are very similar. Because in all reality, a bonds payable really is a note, is a long-term note. However, it is not a note to any one specific person, and it's more readily marketable, and there is an actual bond market that it can sell in. Now, there are some special situations that can occur with a notes payable. So when we're issuing notes for property, goods, or services, uh, we assume that the stated interest rate is fair. Um, However, this may not be the case if there's no interest rate that's stated. If the stated interest rate is deemed unreasonable, and if the face amount is materially different from the current cash price uh, for the same or similar items, or from the current fair value of the debt instrument. Now, when there is no stated rate, so we're looking at this one here. Interest is the difference between the face value of the note and the fair value of the property or services or goods received. So we have to enter into, choices of interest rates sometimes. This happens when there's not an easily, readily determinable fair value amount for the property, goods, service, or any other rights that were received in exchange for the note. And the note has no ready market. Then what the company has to do is they have to approximate an interest rate because there is no ready note for the market, and there's hard to determine what the fair value of the property, plants, and equipment is. This adds a challenge to determining the present value. This process that we have to engage in is called imputation, and the resulted interest rate is the imputed interest rate. These are terms that you probably want to be familiar with because there's a difference between implicit, imputation, stated, and effective. So the first thing we look at is prevailing rates for similar types of interests, uh, debt instruments. Then we look at restrictive covenants, collateral, payment schedules, what the existing prime interest rate is. When we engage in determining an imputed interest rate, this amount will be used over the entire life of the loan, regardless of later changes in prevailing rates, which is much the same as like our effective interest rate method. We don't constantly change it based off changes in the prevailing rates. So, to present an example of that, we have Wunderlich Company, who issued a promissory note to Brown Interiors for architectural services. The note has a face value of 550,000 and a due date of December 31st, 2022. It bears a stated interest rate of 2% payable at the end of each year. Now, Wunderlich cannot readily determine the fair value of the architectural services, and this is not a note that is readily markable. So, based on their credit rating, this is not a collateralized loan. The prime interest rate at that date and the prevailing interest of their other types of debt, they assume an imputed rate of 8% interest is appropriate. So using that, they then look for what the present value of the 550,000 due in 5 years at 8% interest payable annually would be. And that is a present value factor of 0.68058. They then ascertain what the present value of the 11,000 interest payable annually for 5 years would be at 8%. This is the present value factor of an ordinary annuity, regularly scheduled payments. To ascertain what the discount on the notes payable is. So at issuance, they would have their building or their construction in process because this is architectural services. So we have an assumption that it's a construction process and would eventually go to the building account of 418,239. We have our discounts on notes payable of the calculated 131,761 to represent the full debt obligation of 550,000 at maturity. We will create a schedule of note discount amortization using the effective interest rate method. Now, keep in mind that at the point of issue, we have that 2% that we're having to pay annually, but we imputed that 8% is actually what it probably should be to be really relevant interest for the point of issue. This is the same as the bond and the discount. So we have 8% of the carrying amount. And that tells us it should be 33,000 because we are only paying 11,000. That leaves us a bond or not bond, notes payable discount that is amortized of 22,000. This slowly over time, as you can see here, will increase our carrying amount of our note, resulting in the ultimate culmination of 550,000 at the point of maturity. So we recognize the full 33,000 in interest in that first period. We then reduce our discount on notes payable by the 22, and we have the cash payment of 11. A common type of notes payable that is engaged by partnerships, proprietorships, some LLCs, smaller companies, is what's called a mortgage notes payable. This means that it pledges title of property as security for the loan. So this is completely collateralized. It is a very common form of long-term notes payable. So with a mortgage notes payable, it can either be completely payable in full at maturity or in installments along the way. That's going to define how you are going to recognize this between current and long term. The amounts that are payable within the next year, the operating cycle, related to this loan would be current, and then anything above and beyond that period would be the long term portion. It can be a fixed rate mortgage that says something such as 8% for the full term, or it could be a variable rate mortgage. And this is a note that will adjust at specific, defined, and regular intervals. Sometimes this is every year, being that it will adjust annually, or it could be every 3 years. It just depends upon the terms that are in this mortgage notes payable. That will also define whether it's going to adjust to either a factor of the prime rate at a specific date and time, or the U.S. Treasury bond rate, which is relatively the risk free rate. Now, last but not least, before we look at presenting and analyzing long term debt in class, is the fair value option. This is an option that companies have to record financial assets and liabilities, such as bonds and notes payables, at the fair value. FASB believes that this measurement for different types of financial instruments provides more relevant and understandable information than the basic amortized cost. So, to do this, we take those non current liabilities and we record them at their fair value. Now, any differences would be an unrealized holding gain or loss and reported as a part of net income. Uh, there is a lot of acceptance and support for this option. So we will illustrate it using Edmunds. They issued 500,000 of 6% bonds at face value on May 1st, 2017. They decided to choose the fair value option for the bonds. So at December 31st, 2017, which is their reporting date, the value of the bonds is 480,000 because interest rates in the market have increased to 8%. So they will adjust bonds payable 20,000 and they'll recognize an unrealized holding gain or loss to their net income of 20,000. Once you have chosen the fair value option, you must uh, keep it. You have to continue to adjust according to specific dates and fair values on those dates. So, for example, here it looks like they're choosing the end of the year right before for financial statement purposes. You cannot bounce back and forth between the fair value option and an amortized cost. Once you make a choice, that is your choice, and you must carry it forward. We'll discuss presenting and analyzing long term debt in class, and we'll have a lecture on that, including looking at some of the key ratios and what they tell us. Because long term debt is really important in the leveraging of an organization, and it represents how capital was obtained in order to provide the assets. Because assets equal liabilities plus owner's equity, we fund an organization one of two ways. We do that either with a stock issue, so we sell ownership or equity in the organization, or we do it by borrowing funds. The two different manners in which we do this give us different representations. Our ratios will represent differently. It's going to really strategically depend upon the organization. There is no right or wrong. There are some general industries that have much higher debt values than others. And then there are some that have almost no debt. We will look at this on a global, larger type of situation, as well as off balance sheet financing and some of the rationale behind that. But that is definitely a little bit. Now the word is eluding me. Not offensive, controversial, as a method of financing. And we will talk about that a little bit as well. Have a wonderful week, and we will dial into the reporting next week.